you're ignoring a critical signal that could decimate your crypto portfolio, even in the middle of a bull run. Get this, a prominent Bitcoin mining stock, American Bitcoin Corp, just lost almost half its value. I'm talking a 43% nosedive in just 30 minutes. And here's the real twist, the part that should make you sit up and pay attention. This all went down on a day when Bitcoin itself was actually rising. Most people just assume mining stocks follow Bitcoin's price, but this event completely shatters that idea. It proves that's a dangerously flawed way of thinking. So what on earth really caused this collapse? Well, by the end of this explainer, you will understand the exact hidden risk that triggered this crash, and more importantly, how you can shield your own investments from the very same fate. Okay, let's dive right in. I want you to think of this like we're investigating a crime scene, and the central clue, it's this absolutely baffling contradiction at the very heart of the event. Just look at this comparison. It's wild. On one side, you have the stock, ABTC, just falling off a cliff. At the exact same time, Bitcoin itself, the very asset this company is supposed to be all about, was having a fantastic day, rallying past $91,000. This is what we call a total decoupling. A proxy investment crashed while the asset it's supposed to track was doing great. This is the mystery we need to solve. All right, so like any good detective, our first move is to rule out the usual suspects. We need to clear away all the market noise from that day and see what's really going on underneath. So you might be thinking, well, maybe the whole market was in a panic. Nope, not at all. The NASDAQ and the S&P 500 were both up. We had all this other news flying around, Trump and Michael Dell launching an investment fund, talk about replacing income tax. Heck, Bank of America even came out with a major bull signal recommending crypto to its clients. None of these headlines can logically explain such a targeted, severe crash in one single stock. And this quote just hits the nail on the head. Some early reports tried to just blame it on, general crypto volatility. But that explanation completely falls apart. The math just doesn't add up. Bitcoin was up, not down. The simple, lazy explanations just don't hold up, which tells us the real reason is something deeper, something specific to the stock itself. So if it wasn't the broader market, what was it? All the evidence starts to point in one clear direction. The problem wasn't the market, it was the nature of the investment itself. And this brings us to a really crucial idea, the proxy investment. When you buy a mining stock, you are not buying Bitcoin. Let me say that again. You're buying a company that mines Bitcoin. That means you're not just betting on the price of crypto, you are also betting on that specific company's management, its debt, its operational efficiency, the whole shebang. And this table perfectly illustrates that hidden danger. With a mining stock, you've got this massive layer of company-specific risk. A single big investor can decide to sell their position. A rumor about operational problems can start. Things that have nothing to do with Bitcoin's price can absolutely destroy the stock's value. But with spot Bitcoin or an ETF, that whole layer of company risk is just gone. Your only asset directly. Okay, now that we've really zeroed in on the risk, let's talk about the solution. This is how you can build a smarter, more resilient crypto strategy. So the core takeaway here is simple. You have to build your crypto portfolio on a solid foundation. And that foundation is direct ownership of the asset itself through spot Bitcoin or a reputable spot ETF. That move alone eliminates the company-level risk that just crushed those ABTC investors. Now, if you want to add more risk for a potentially higher reward, you can then consider things like leverage trading the asset directly. You're still closer to the source than you are with a proxy stock. Ultimately, this strategy is all about prioritizing the core, established assets over these speculative, complex proxy plays. Let's be honest, many of these smaller mining companies might not even survive the next bear market. They can fail for reasons completely disconnected from the health of crypto. Sticking with the big dogs, the actual asset, is simply the more prudent path. Understanding this hidden risk is exactly the kind of insight that separates successful investors from the crowd, and it's the kind of deep dive analysis we specialize in here at Crypto Global News. So, if this explainer helped you see the market a little more clearly, help us spread this critical knowledge. Go ahead and hit like, share, and subscribe to Crypto Global News for more deep dives that cut through the noise and help protect your portfolio.
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.